Welcome to the show, folks. Today we're talking about the Oracle of Omaha himself, Warren Buffett. This guy, let me tell you, he's not just some rich dude who throws darts at a stock page. He's built an empire, a real money-making machine, by following a set of simple yet powerful investment principles. We're talking about 10 golden rules that can turn you from a market newbie to a savvy investor. All right, let's kick things off with Buffett's first rule. Invest for the long term. Look, I get it. In this market, everyone wants to be a day trader. Everyone wants to get rich quick. But Buffett, he's not interested in that noise. He's playing the long game, folks. He's looking for companies that are built to last, companies that are going to be churning out profits for years, even decades to come. Think of it like planting a tree. You don't plant a tree expecting to eat fruit the next day, do you? No! You plant it, you nurture it, and you wait for it to grow. That's what Buffett does with his investments. He finds solid companies with strong fundamentals, and he lets them grow. Remember, Rome wasn't built in a day, and neither is a fortune. Don't get sidetracked by the latest meme stock or the flavor of the month. Focus on the long-term potential, and let the power of compounding work its magic. This isn't about timing the market, folks. It's about time in the market. The longer you're invested in a good company, the more opportunity you have to ride out the inevitable ups and downs and come out ahead in the end. So ditch the get-rich-quick mentality and embrace the power of long-term investing. Rule number 2, and this one's crucial, folks. Understand what you invest in. Buffett doesn't invest in things he doesn't understand. He doesn't chase after the latest tech jargon or complex financial instruments. He sticks to what he knows. Listen, investing isn't about gambling. It's not about throwing money at something and hoping for the best. It's about owning a piece of a business you believe in, a business you understand. Before you buy a single share of a company, you need to do your homework. Read their annual reports, understand their business model, know their competitors. What are their strengths? What are their weaknesses? Would you buy a whole farm without inspecting the crops, the soil, the equipment? Of course not. So don't buy a stock without understanding the company behind it. Knowledge is power, and in the world of investing, knowledge can mean serious profits. Now let's talk value, baby. Buffett isn't interested in overpaying for anything, and neither should you. Rule number 3, look for value. He's like a bargain hunter at a flea market, always on the lookout for hidden gems, those undervalued companies that everyone else seems to be overlooking. See, the market isn't always efficient. Sometimes good companies get mispriced, their stock gets beaten down for reasons that have nothing to do with their actual business. That's where you come in, ready to snatch up those bargains. Think of it like buying $1 for 50 cents. That's what Buffett's looking for, companies with intrinsic value that's far greater than their current market price. Remember, price is what you pay, value is what you get. Look for those companies that are trading at a discount to their intrinsic value, and you'll be well on your way to building a Buffett-esque portfolio. All right, rule number 4 is a real gem, quality over quantity. Look, I know it's tempting to diversify your portfolio with dozens, even hundreds of stocks, but Buffett, he's not interested in owning a little piece of everything. He'd rather own a big piece of a few fantastic businesses. Think of it like this. Would you rather have a drawer full of cheap, disposable lighters or one high-quality Zippo that's built to last a lifetime? That's the Buffett approach to investing. He concentrates his investments in a select few companies that he knows like the back of his hand. He's not afraid to put a significant chunk of his money into these businesses because he believes in their long-term potential. Remember, diversification is important, but only to a point. It's better to own a few amazing companies that you understand and believe in than a bunch of mediocre ones that you know nothing about. Find those high-quality businesses with strong track records, great management, and durable competitive advantages. Now this next rule is classic Buffett. Be fearful when others are greedy, and greedy when others are fearful. It's contrarian thinking at its finest, folks. When everyone else is rushing in, buying up stocks at inflated prices, Buffett's got his guard up. He knows that when emotions run high, logic tends to fly out the window. Think of it like a crowded theater. When everyone's rushing for the exits, it's usually not the best time to be heading in. Buffett's wired differently. He sees opportunity in chaos. When the market tanks and everyone else is panicking, that's when he gets to work, scooping up bargains and building his wealth. Fear and greed are powerful forces in the market. So, the next time the market throws a tantrum, don't panic. Take a deep breath, assess the situation, and look for opportunities to buy low. Alright folks, this next rule is simple, but it's easier said than done. Stay disciplined. The market is a roller coaster, folks. It's full of ups and downs, twists and turns. It can be exhilarating, but it can also be downright terrifying. But here's the thing. Buffett doesn't let emotions dictate his investment decisions. He doesn't buy and sell on a whim or chase after the latest hot stock tip. He sticks to his guns, follows his strategy, and tunes out the noise. Think of it like a diet. It's easy to get excited about a new diet plan, but the real challenge is sticking to it day after day, even when you're craving that extra slice of pizza. Investing is the same way. It's not about getting rich quick, it's about making smart, calculated decisions over the long haul, even when the market is testing your patience. Stay the course, and you'll come out ahead in the end. Now let's talk about the magic of compounding, folks. Rule number 7. Reinvest your earnings. Think of it like a snowball rolling downhill. As it rolls, it picks up more snow, getting bigger and bigger. That's what happens when you reinvest your earnings. When you reinvest dividends or capital gains, you're essentially buying more of the asset that generated those returns in the first place. Over time, this creates a powerful snowball effect, allowing your wealth to grow exponentially. Reinvesting earnings is like putting your money to work for you, earning you even more money, and then putting that money to work too. It's a virtuous cycle that can supercharge your returns over the long run. So, don't underestimate the power of compounding. Reinvest your earnings, let your money work for you, and watch your wealth grow like a snowball rolling downhill. Alright folks, let's talk diversification. Rule number 8, diversification is important but not excessive. Now, I know what you're thinking, but Jim, isn't diversification all about reducing risk? And yes, to a point it is. But Buffett's got a different take on this whole diversification thing. He believes that over-diversification can actually hurt your returns. Think about it. If you invest in hundreds of companies, you're essentially betting on the overall market, not on the specific companies themselves. And let's be honest, not every company is going to be a winner. Buffett's philosophy is to focus on a handful of truly exceptional companies that he understands and believes in. He'd rather own a significant chunk of a few great businesses than a tiny sliver of hundreds of mediocre ones. So, diversify your portfolio, but don't go overboard. Focus on quality over quantity. Now this next rule is often overlooked, folks, but it's critical. Emphasize management quality. Buffett understands that a company is only as good as the people running it. He looks for companies with strong, ethical, and shareholder-friendly management teams. He wants leaders who are passionate about their businesses, who are good stewards of capital, and who are committed to creating long-term value for their shareholders. Think of it like this. Would you invest in a ship with a captain who doesn't know how to navigate? Of course not. The same principle applies to investing in businesses. A strong management team can make all the difference. They can guide a company through tough times, capitalize on opportunities, and create a culture of success. So when you're evaluating a potential investment, don't just look at the numbers, look at the people running the show. And last but not least, folks, rule number 10, be patient. Listen, I know in this day and age, everyone wants instant gratification. We want it all and we want it now. But real investing takes time. Buffett didn't become a billionaire overnight. He built his fortune over decades, brick by staying patient and letting his investments compound over time. Think of it like planting a seed. You can't just plant a seed and expect a tree to grow overnight. It takes time, it takes nurturing, and it takes patience. Don't get discouraged if you don't see immediate results. Be patient, stay the course, and you'll be amazed at what you can achieve. There you have it, folks. Warren Buffett's 10 golden rules of investing. These principles have stood the test of time, and they can help you navigate the market and build wealth too. Remember, investing isn't about getting rich quick. It's about making smart, disciplined decisions over the long haul. So, do your homework, stay informed, and most importantly, stay disciplined. Go plant your tree.